Well, that's the move we've been waiting for. Like, we've gotten multiple attempts at a good, strong rally throughout the week, but it just couldn't hold the rally by the end of the day, right? That famous Seinfeld reservations bet that he had on one of his early episodes. Just couldn't hold it. And the most important thing is to hold the rally by the close. And we finally, not only did we hold the intraday move at the close, but we actually extended it and closed right at the high of the day. So really, really good move. Okay, do we have the low point set? What does it look like? What do these indicators look like when we are at the low point, and are we there? So we're gonna break that down. We're gonna take a look at this move and see how trend changing it was or not, and talk about kind of what's driving, how these different asset classes move. Very big surprising move on the dollar this week. We'll talk about it and talk about why. We'll look at the different sectors and how they're performing. Some interesting moves there too that we'll talk about. And then our trade idea is a stock that's been relatively bullish, that's been consolidating, and looks like it's continuing to consolidate. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, January the 28th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's go ahead and take a look at the S&P 500 here with the market forecast indicator. Let's bring that up. As you can see, a great close to the week. Getting that rally that we've been kind of looking for. Brought the momentum line, highest close of the week. We closed higher than we did on Monday's close. We got the momentum line up into the reversal zone, but not, to extreme levels. The near-term line's up in the upper half of the chart, but not in bullish territory yet, much less in the reversal zone. So it's a great short-term improvement, but you notice, while it was the highest close of the week, it wasn't the highest level of the week. We actually got to a higher high on Wednesday morning before we fell into the close on both Wednesday and Thursday, and for that matter, even Tuesday, coming off the highs all 3 days. So we are still 4% below the moving average. It's, again, you get your biggest moves when you're below the moving average, and as I've mentioned to you multiple times, here we are, like, we got a 2% rally coming off of how many days in a row did we have? Like at 1, 2, 3, 4, 5, 6 out of 8 days with 1% or more losses without a single 1% or more rally. And then you got a couple smaller losses, but with big ranges, right? Big gaps to the upside on both those days. And then finally, we get the close that you would expect, that we expected to see. So, you see the bearishness started post Thanksgiving. There's the post Thanksgiving low point, the big gap down, the big finish down. You can see we had big 1% plus moves, even a 2% rally during that weakness, and then now it's the same thing, right? So this is just a good strong move within what is currently a bearish run. We did close up above. Let me get rid of this. We did close up above the 23% retracement line. We did not close above the 38. There's going to be resistance here at 44.50. There's going to be resistance at 45.92, which is probably where the 30-day moving average is going to be if we were to get up there. So we've got some strong resistance levels. I wouldn't necessarily say that this is the low point. You'll hear a lot of chatter about this being the low point. The Russell 2000 hasn't even gotten above its 23% retracement yet. It tried to the day after this particular level, but we got the lowest low point there. We actually on the low hit the 38% retracement of the entire post-COVID rally. So remember the S&P still hasn't even broke the 23% line, much less touched the 38. So big bearishness on the Russell. We're still 8% below the 30-day moving average. So this is hardly a trend-changing rally. Same with the NASDAQ. We're 7% below the NASDAQ. And remember, I expect that will actually get to zero pretty closely before, and still not even necessarily be bullish, right? You can see we are a smidgen above the 23% line there, which also happens to line up exactly with the 23% retracement line of the entire post-COVID rally for the NASDAQ. Right, so we did get above those lines. You have resistance here at 14,825. You have another resistance at 15,500, where that 30-day moving average is. So that's where we're at. The rally on Friday was not surprising in the least bit when you are that far below moving averages. When you look at the weekly charts for these market forecasts, we'll come back to NASDAQ in just a second. If you take a look at the SPX, you see we have light green shading in the green line. The intermediate line still in the reversal zone. Even if you have really bearish short-term sentiment last week, that really, that close last week was below a lot of different weeks lows there. So very, very bearish drop. And then your rally this week, which is kind of what we talked about last Friday, we'd expect this week to be a bullish week. Look at the NASDAQ, dark pink shading and a red line. So the intermediate line has fallen below 50. Short-term sentiment strongly bearish. And we are well below the 30-week exponential moving average to the point where it's turning down. So dark pink shading and a red line. Last time we got that was COVID. Before COVID, the last time we had that pattern was fourth quarter 2018, and then 15 and 16. So this is pretty unique to get dark pink shading and a red line on the weekly chart. You notice on the Russell 2000, we've been in dark pink shading and red line mode for a while. We had been in fourth quarter 18, COVID, 15, 16. So we've seen this before, but we have been in a while now, and we're well below. We've been dark pink shading for multiple weeks in a row. In fact, we got a weekly cluster. We got an oversold cluster on the weekly chart, which is again, to kind of give you an idea, the last time we got an oversold cluster on the weekly chart was at the end of the fourth quarter 2018, as well as here in 15, 16, the beginning of 16. So both of these kind of marked the end points for both of those declines. Being 12% down. If I were to go back to 20 years to find other clusters, there's the cluster in 2011 that we got that also marked that low point there. And then you can see didn't quite get a cluster in 2010, and all the clusters that we got in 2007 and 8, right at the end, pretty much right at the very beginning of 2008, and then ultimately at the very end, the worst of it. No other real cluster since and previous to that, we did get a cluster right there at the end of that selling in 2004 that led to a higher. So you see how rare it is to get these clusters and how it typically lines up with some kind of low point. If it's not an extreme low point, at least the early stages of a low point like we saw over here. At least it was a short-term low point at those levels. So real bearish low, market forecast is strongly bearish, and again, my expectation is just like it was this week, that we'll have probably another week, another bullish week next week too. Probably without the same size range that we had. If you look at the Hakinashi candles, we have a really bearish candle here for S&P 500. We're not going to get a bullish candle next week, though we are relatively close. We're only, the open's going to be right around 44.80. We're trading at 44.31, so that's actually not that bad. You can see the NASDAQ has been more bearish for a while. This is now our fourth week, and we are well below the 40-week exponential move, well below the 40-week exponential. Falling PPO, a really significantly large candle. Again, to kind of give you an idea, going over to the left, this is about as big as the candles got in each of those other market sentiment declines that we always compare this move to, 2011, 15, 16, and 18. Right? The PPO is actually still bullish. Back here, and by the time we got to this level in 18, we were bearish there. By the time we got this level, we were relatively bullish there in 15. And then in 2011, we were also right about this level too. And both those instances got just a smidgen bearish. So no bear markets, just kind of a corrective mode. Of course, there's your real bear markets over there on the right. Your Russell 2000, its candle was really big. This is one of the bigger ones we've had in a while. Again, kind of give you an idea, if you follow my cursor along, there's a fourth quarter 2018, there's 15, 16, and there's 2011, as well as the financial crisis over there in 2008 and 9. So a pretty significantly large candle, and probably not going to get a bullish candle here on the Hakinashi for at least another week or two, even if we get kind of a pause, a rally to the upside next week. Let's take a look at the 3 green arrows charts on the chart. We have a green arrow on the stochastics here. No, not yet there, but really darn close. A green arrow on the stochastics and the diamonds. Not quite there on IWM. So that's where you're getting the light, the clear shade. Not pink or green. We're kind of clear on that, but you get that a lot during the bearish runs, right? So take that with a grain of salt until you see that green. 3 green arrows. You can see you go from light pink to white to back to light pink pretty quickly for the most part. And again, if you were to go back to fourth quarter 2018, you had brief periods of green before we turn right back down with the red arrows, right? So, but you don't get the long periods of pink like you do when you're bullish, when you get these long periods of 3 green arrows there. When you look at the 2 line versions of the chart, and you can see a 2.5% rally, all that did was get us a smidgen above the 8-day moving average, and still did not get us above the 200-day moving average. And it basically got us to the point of control and not through it, as well as that 38%. So when you look at the point of control, when you look at the Fibonacci line, when you look at the 200-day moving average, there's some pretty strong resistance in this area, as well as the 17-week, which will be right above 17 days, excuse me, which will be in that 50% mark. And then by the time we got to the 62, your 30-day is going to be up there at that level. So you'll have some resistance there too. When you look at the NASDAQ 100, you can see the 17 is now crossed below the 30. You also have some resistance there right around the 50%. So you'll have some pretty strong resistance on a rally up towards these levels, as well as the 30-day and the 50-day, which will be at the 62 if and when we got to that point. And then the small cap stocks, we are extremely bearish on the Russell. Have been and continue to be, and we're still not even to the 8-day. We're still quite a bit away from the 8-day. So I actually still expect, if we get a bullish week next week, I think it'll be, the Russell will really outperform versus some of the other large cap indexes. It has a lot of room to run up just to get to the 8, much less the 17, which are far below significant resistance levels. You look at Fibonacci lines on this. The 23% retracement of the big long post-COVID rally is sitting right on the 38% line. Your 30-day is probably going to be sitting there too. Your 17-day is going to be sitting at the 23% rally by the time we get up to it. So we have, a lot of resistance for Russell, but a lot of potential moves to the upside, if it were to really kind of take off here and really outperform its large cap counterparts. When you look at some of the other oscillators, there's your S&P coming out of really bearish territory, but still in bearish levels. Your NASDAQ 100, same thing. Your Russell 2000, it's still pretty bearish, right? It's out of the reversal zone, which is pretty rare to get into, but still relatively bearish there. When you look at the weekly chart, we have finally just crossed below 40. We haven't crossed below 40 yet on the SPX. We did get below the midpoint, but we haven't crossed below 40, and the same thing with the NASDAQ. You see the CCI for the NASDAQ did get below negative 200, and so has the S&P 500. So, there's just some, we're hitting some pretty strong bearish levels. Needless to say, I don't think, like I said, that the low point is set in here. When you look at the directional movement index, you can see we've been so bearish. We're still, well above 25. We're still well below 20 on the positive. Even if we're not as extreme as we were. Same thing with IWM. IWM is still above 30, still below 10 on its directional movement index, and you can see the same thing on the NASDAQ. That's on the daily charts. When you look at the weekly charts, you can see we're just breaking out on the NASDAQ. We're just breaking out here on SPY. This is the first couple of weeks we've been above 25. And then IWM, you can see, has been. Its ADX is actually about to cross above 25 this week. So we are still in the midst of starting these bearish trends here. When you look at the Ichimoku cloud, you can see the strength of the trend, -7, 88. The IWM also, we got the strength of the trend going right now too. We are -7 and 88 there too. And then the Qs, -8 and up to 89. So very strong trends on the Ichimoku, well below the clouds on all of these. Well below the clouds, right? IWM especially, way below the cloud. If you look at the Bollinger Bands, let's throw on the the there the Keltner channels too. We are back above the Keltner channel, so we're not in that trending mode anymore. We're not in that, and we are out of the lower quartile there. That's on SPY. If you look at IWM, we are still in the lower quartile, and we're just barely up above that Keltner channel. And then looking at the Qs, you can see also the same thing. So we are out of the lower quartile, and you can see the momentum is turning back to where we had that yellow bar, which means we're starting to decrease the bearish momentum, which kind of aligns with what we see with the MACD and the stochastic indicator, right? With the histograms rising. We're not converging yet because the MACD hasn't crossed above its moving average. We don't have the green arrow yet. And we're not diverging to the upside yet because we're not back above the 17-day moving average. But you can see the bearish momentum is definitely slowing at the very least, if we want to call it that. So that's kind of how these charts are looking. If you take a look at the intraday moves, here's the intraday moves on SPY. You can see a good close at the high of the day, at the high, pretty much at the high of the week. And what's really significant is we closed above last week's low point. We filled in this gap from Monday. We filled in lots of gaps all week long. We still haven't filled in that gap from Tuesday on the 18th. So we're still kind of in that mode there. And you can see that there's that 18th runaway gap that we can consider on SPY. Remember, IWM actually got that runaway gap. When was it back over earlier? We actually did fill it in a little bit later. Initially, when we initially got that, we did fill it in just a few days later, but that was it. And you can see really there's that same runaway gap on the 18th that we've had since then. So, but you also see that the IWM here, let's go back to here. You also see here that we did not get above last week's low point. We did get above yesterday's low, so lower high, lower low, but above yesterday's low, not as bearish, closing at the high of the day, but we did not get above last week's low point on that. So you see how the diamonds, we did get above last week's low point, and then the Qs, we did not. In fact, we kind of hit it as a resistance. Last week's low point we hit as a resistance, but we did close at the high of the day. So not as bearish as it could be, but still bearish enough on the NASDAQ and the Russell to be below the low points. When you look at the volume in the trading range, we still have strong volume, 164 million. The trading range was 14 points on SPY, so still very, very high levels. And we have, we're above 2% on the ATR right now. The ATR is almost at 10 points. That's how big the ranges have been. The volume is up to 120 million. I mean, it's been a while since we've had this level of volume. COVID, you can see, there's the fourth quarter 2018, there's 15 and 16. We're headed up to that. Now, remember, the price back in 15 and 16 was at $200. So, of course, the volume is going to be, double what it is now because the price was half of what it is now. Even 2018, we were at 275 versus 441. So, of course, the volume should be a little bit higher than where it's at right now because there's more money being trading hands for each share because of the price change in the ETF, and COVID was just a singular event. But to get back above 2% is pretty significant. Like we didn't get above 2% in the first quarter of 2018. We did at the very end of the fourth quarter, and we did again slightly there in 15 and 16. Let's look at volatility. This is another thing we look at to see, okay, is this the low point? Well, we want to see, does volatility really jump higher? Does it get up to this 105% level? Now, I brought up on a tweet yesterday, I brought up that when you gap up above 105%, and then close that same day below 100%, then that can signal a short-term bottom. And you can see volatility ended up finishing the week down to 95, like well below 100. In fact, we only closed above 100 once, and it was barely above 100, like out to the fourth and fifth decimal spots to get something that's above 100. So we still like we close above 100 by more on that post Thanksgiving decline. We haven't even yet. So again, for like I've been comparing this to 2018, right? 2018, fourth quarter 2018. Look how high we got in volatility relative. I mean, and we actually hit lower levels than we're hitting right now. Look at 15 and 16. Look how high we got over here when we started it in 15. Again, about the same levels that we are at right now is where we got up to, and the VIX was much higher. So what does that tell us? That tells us that VIX 3M is still really high. So what does it tell us when VIX 3M is really high? It tells us the market's still concerned about longer term declines. When we look at the skew, there's a few things I look at on these charts. I'll come back to in a minute. But one of the things you look for in this chart to say, okay, we're done, right? Like we've experienced what the skew has been trying to price in, these big 1 standard deviation moves. Well, if you look at here, let's go out to a weekly chart so we don't get so much noise, ups and downs here. But you can see, and even just in COVID, but there's your fourth quarter 2018, the skew dropped below 120. In 15 and 16, you notice we dropped below 120, 122 and a half, 120. We're not below 120 right now. We dropped below 120, barely, but we dropped below 120 during that normal intermediate decline. We're not dropping below 120 here. So, it gives you an idea of just like we're just not quite there yet. Look at the average. The 20-day average now for the skew is actually still higher at 143 compared to even the peak of the skew when it peaked there preceding the fourth quarter of 2018. So skew is still very high, which means the market is still concerned about big outsized moves that last a long time when you combine it with the VIX 3M still being relatively high. So the market's still not sold that we've hit the low point. There might be a low point, it might be a short-term low point, but it's not necessarily the low point that will turn us back into now a new intermediate run, and now for the Russell, a new market sentiment run up to the upside. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked the video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't like it. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have about anything I brought up in the video today? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things on the page as well. Here's the video, of course, and you can see some of these other things along the right. Our most popular blog post right now. Brandon updated his sector watch lists over the weekend, so you can check that out there. Here's our upcoming classic. Click on this Market Outlook Live icon. That takes you to this page. Here you can see every day I do the Market Outlook, I do a live video at 3:30 Eastern Time. Quick little 10-15 minute video. We just look at the trades that we currently have on from all the past Market Outlook videos, see whether we should stay in them or get out of them. Then we also put on today's trade idea already. So, Monday morning, by the time you have the opportunity, we've already gotten in a Friday before the market closed. So that's how you can check that out there. You can see all the archives, multiple years worth of archives there. You can also get to it by coming up here to the top and clicking on Live Trade Review. You see our upcoming classes, click on View More. You can see our calendar with all of our recordings here, as well as our upcoming classes as well. Come down to the bottom. Look, we almost got 100 likes. So I got really close there. Again, click on that heart. It takes you to a new tab. Hit that like button. Again, the more you do that, it really helps us get more, get our content out, especially when you retweet it as well. like we had 25 there. It really helps get our content out to more and more people. More people see it because of that. And you can see the activity here. You get more of these when you have more of these. And so that's why we always ask for the likes and the retweets and the comments, right? Same thing with Facebook. Click that icon. It takes you to this page. And again, the more engagements we have, the more people see our content. And so, same thing. The more you can like it there. And you can do it right here from this page while you're watching right now even. All right, now let's take a look at what's driving this price action. You can see look at the dollar and commodities moving up together, and gold and a little bit late drop here the last few days with the rally up in risk asset classes, but the dollar didn't drop and commodities never did drop or rally. It just kind of stayed, moving along. Let's take a look at just this week that was here. So coming into the beginning of the week, you can see it was a strong dollar week all along. The dollar had a really, really good move. Not so much today, but really good move for most of the week, Thursday especially, when we had the biggest declines there intraday. But commodities held up too, which is interesting because usually those two don't go hand in hand. The dollar and commodities usually go separate, which again kind of shows that the dollar is kind of doing its own thing right now. It's not necessarily a safety trade like it has been in the past. When you look at the major currencies here, and again, just going back to this last week that was, you can see that the dollar was the strongest currency by far. It just killed everybody, right? The yen was there. There's the franc. The franc was down here. Excuse me. The pound's up here. The euro's there. The euro outpaced a lot of these other currencies. The Aussie and the Kiwi getting hammered. Commodity currency. Remember, commodities were up, but the commodity currencies all lagged, which is not normal for these. So the dollar was kind of its own animal, even though commodity prices themselves all rallied so much. So kind of a risk off week, kind of not. As I saw, again, going back to the asset class comparison chart here, I'm just going to this week that was, and go 5 minutes. You can see, things were down at one point. The small caps or emerging markets were down 4.5%. They still finished down 3.5%. The Qs were down 3.5%. They finished positive. Small cap stocks were down 4.5% almost. They almost finished positive, a little bit less than 1% down. Spiders were down at one point early in the week. Were down 3.5% on Monday. They finished positive by 1%. So it was kind of a risk-off week, but not really. And so the dollar, again, kind of really doing its own thing. And you see that in some of these charts, like looking at UUP. Look at that big move on Thursday. In fact, you could almost argue it's almost a little bit of a blow-off top type move. We've already been relatively bullish with a very strong trend. We've been consolidating that trend. And then we just spiked up with a big move to the upside. If you look at the volumes here on a weekly chart and look at all of this week's volume, you can see we were up above 1.5 times. And again, most of that move here was a gap up to the upside overnight. So when you look at the euro US dollar, because you remember the dollar index is 60% euro US dollar, it looks like we're potentially forming a divergence pattern here. Remember, we have to get below that 78% for this. We had this rally on the euro. The dollar's been pulling back pretty much all of 2021. We're at that 78% level. It's already a lower low point. If you look at these oscillators here, you can see here. Go back to that 2-year chart. So, it's this. Sorry, euro US dollar. That's why it looks different. There we go. So there's that run. There's the pullback. There's the low point, which is already a lower low point down to the 78% line, and also this humongously big trend line, right? So that trend line, that blue line, comes all the way from those peaks from 15 years ago, right? So we're sitting there on that trend line. We're sitting at lower lows already with the oscillators themselves. I don't know how that went to a. There we go. With the oscillators themselves showing higher lows. So we're not back below 30 on the RSI. We are in bearish territory, but not back below 30. We are a little, we did get below -200, but not as low as we got over here, -250. So we got the higher oscillators. We got the potential for this divergence, especially again, like I said, on the weekly chart and on the MACD and stochastics. So it looks like the dollar may have just kind of like had a blowout top this week, and again, it is very correlated to the risk asset trade in generally, but not the way that we expected it. What's interesting too is TLT, which is the 20-year, 30-year long-term yields, not the 10-year. Right, that's IEF, but the 20 and 30-year, you can see, it looks like we're in this bullish convergence. The MACD is above its moving average, and we're just about trying to get above that. So we're above the 8. We're trying to get above the 17-day exponential moving average there. So it looks like it's trying to get going. That's much better than what we see on IEF. IEF, which is the 10-year, it's still below. It's just barely above the 8, much less above the 17. And it's way below the 20-year, and it's way down here below the value area. So you see the difference. Long-term yields look a little bit more bullish because, again, they're not as impacted by short-term rates. Look at SHY, which is a lot more impacted by the Fed funds rate. Look how bearish it is. And so when you look at TLT relative to SHY here, when you look at TLT relative to SHY, so the long term relative to the short term, you can see that TLT had been underperforming, but it looks like it's going to start outperforming. Right, so long term bonds, the MACD is rolling up. The PPO had been falling, but now the histogram is rising. The CCI is rising. The DMI is not as bearish as it was. The RSI is rising. So it looks like the market might be shifting towards, again, from a fixed income standpoint, away from short-term bonds and back in the, short-term bonds have been falling this whole time, but they've been falling a lot more. Long-term bonds have been falling more than short-term bonds have been. Now you probably would expect it to be the other way around, which again, when you look at the yield spread here, the yield spread for the 10-year minus the 2-year, it's at the lowest level of the year. We're at 63 basis points. It's actually a little bit lower than that when you look at the current. Right now we're at 1.172 on the 10-year, and we are at 0.177. So we're about at 60 basis points on the yield spread. So that's going to impact, even though the market itself is now pricing in a pretty strong chance for 5 rate hikes in 2022. So you can see the odds for 1 is 100%, for 2 is 99.9%, for 3 it's 97.8%, for 4 it's 86.9%, and for 5 it is 60%. So we have a high probability now that we're going to get 5 rate hikes. Now there are how many meetings? 1, 2, 3, 4, 5, 6, 7. So out of the 7 meetings, the market's anticipating that we'll get hikes in 5 of them by the time we get to the end of the year. So the market's looking like the Fed's got 60 basis points of yield spread to work with as they raise rates. And the problem is if the 10-year starts to pull back, those long-term rates start to pull back, even though short-term rates are rising, which is what you would see if this goes up, right? If TLT goes up over SHY, if this rises, that means the yield spread's falling. So it could really limit and really kind of, again, if the Fed needs to raise rates more, but the yield spread's already inverted, then it will really put them in a bind and in a pickle, and that's generally what creates a negative environment for risk appetite. Let's take a look at how the sectors are performing here. So let's go to the sector rotation chart, and let's go to the comparison chart here, and let's see how they did here this week. You notice it's a really good week for energy stocks, up 5% this week. Really, really good week. Technology had a good week too, up 2.5%. They didn't start off so strong. They were the worst performer early on Monday, down 5%. They finished up 2.25%, so really big change. Financials were a strong week as well. Discretionary industrials, materials did not do so well. They lagged behind. So your cyclical areas still kind of lagging. When you look at the 12 grid, for these different sectors. Still pretty, I mean, dark pink shading. We're getting light green shading because we're rising with low 20s on the intermediate line, but we're still below these moving averages, and we still have dark pink shading across quite a few. The only one that's really bullish is energy, and I think energy's got, because it's such a extremely small weighting right now in the S&P 500, I think energy has potential to outperform the markets here. So here's the daily chart. But if you go to the longer term chart and look at how this has been performing, especially since the summer of 2000 and here, let's change this too. Especially since the summer of 2014, it's really been lagging. But now it's above the 50 week, and the 50 week has been rising. If I were to now zoom in on these last few years, so that you can see we got above the 50 week. We started to fill in the gap here in 2021 between the 50 week and the 200 week, and we potentially now might shift our way through and break through the 200 week. And I mean, the RSI is bullish, the CCI is bullish, we got a bullish breakout on the DMI, the MACD is rising. Like, there's an opportunity for us to be more bullish than we've been on energy relative to the markets for an extended period of time here, which is very typical of a late cycle move in the markets. It's very typical for commodity stocks and energy stocks to do really well. They've got a lot of room to make up. They've got a lot of, I mean, just like I said, just to get back to, to kind of give you an idea, to get back to where they were in 2014 relative to where we're at right now. At the current level for SPY, we are, energy is what? Where's XLE? So XLE is at 65.63. There it is. So 65.63, and SPY is at 441.95. Okay, so that's where we're at right now. That's what this number is telling us. Well, 149. So if we want to get back up to, what does that be? Right around 4.43, to kind of give you an idea. If the S&P did not change, right? If it did not change, if the S&P just stayed right here where it's at, 441.95, that would put XLE at 190. To kind of give you an idea there, 190 on XLE. XLE here, and let's go to price, and it's at 65. 190. It would have to get to 190. So that's where it was on an absolute. It was at 100. XLE was in mid 2014. Now, granted, as the XLE rises, as this ratio rises, the SPX might actually fall. But it kind of gives you an idea of just how oversold SPY, XLE was, and SPY, and how overbought SPY is relative to XLE. So we have a long ways that we can go. Even if by the time we get to that point, S&P is either at the current levels or higher, that would put XLE at a very, very, I mean, this again shows to show just how overbought it is. Now, of course, I don't think XLE will get to 190. It will most likely, let's say it just gets back to 100, right? If XLE just gets back to 100 here. Well, even if it just gets back to 100, to kind of show you where S&P could fall, right? If the XLE price gets back to 100, then that would put the S&P at 232.5. If we were to get to this ratio, again, in mid-2014, to get back to that ratio of 0.43 with XLE back to 100, which is where it was on an absolute basis there in mid-2014, up to 100. So that would put us at, what did I say, 232.56. Let me show you where that is. 232.56 on SPY. $232.56 is right there. So it's a little bit higher than where we were in 2014, but that's where we'd have to be, right? We'd have to be at the COVID lows. We'd have to be back down to the COVID lows. And, to kind of give you an idea again of what that looks like here on these Hakanyashi candles, 250, what do we say? 255, 232.55, right there. I mean, that's where we'd have to be. We'd have to be well below that 200-day moving average, and again at the COVID low points for that to happen. And we still wouldn't be at, more than 100% move, but we'd be below that 78% retracement. I mean, that would be very significant. Not that I think we'll get there. Not that I think XLE will get to 190. It's going to be somewhere in the middle, but it goes to show that as great of a week as XLE has had against as great of a week that XLE has had here. Where is it? This one. This past week, up 5%, up 13% in the last 3 months. Well, the market itself has been down 3.5%. But if I were to go all the way back to, June 15th of 2014, if I were to go all the way back to there, then you can see there's XLE is down 33%, and the broad market's up 120, 130, even with this pullback. The broad market's up 130. It's got a long, it is as bullish as it has been on the absolute basis. It's got a long ways to go on a relative basis to make up any ground, especially against XLK, which is up 300%, while XLE has been down 1/3 of its value. All right, now let's take a look at our trade idea of the day. So let's pull up Mosaic. That's our stock that we wanted to trade. Mosaic's been an interesting trade. It's been bullish. It actually finished with dark green shading the green line after a period of light pink shading and a yellow line here. But you notice like the market sentiment's in neutral territory, the intermediate line's in neutral territory. If you look at the long-term crossover chart here, you can see we don't have a red arrow, but we do have we don't have a bullish candle either. PPO is falling. We have a negative differential. When you look at the 3 green arrow chart for Mosaic, we have 2 green arrows. Like we've been up and down. We have an rising trend, but we don't have green shading here. So we don't have bearish trend, but we don't have the green shading either. When you look at the 2-line versions of this chart, you can see that the MACD, we're in bullish convergence. We're actually in bearish divergence mode, but not really breaking down. Like we're below the 17-day. The MACD is below its moving average. MACD is actually slightly negative, but your stochastics, which got a smidgen below 40, looks like it might be turning up above its moving average. So it kind of looks like we're consolidating. We were bullish. We consolidated it, but we're not really bouncing either. It just looks like we're kind of consolidating in these areas. If you look at the Bollinger Band width, it is actually falling. It's relatively higher levels, but it's falling. We're above the value area for the 1-year chart. We're right smack dab in the middle of the zone. When you look at the trend strength indicators in the Ichimoku cloud, we're just barely above the cloud. We were below it. We got above it. We're still above it, but we're still below the green and blue lines. We don't have a trending move going anymore. Your RSI and your CCI are in neutral territory for both of them. And then you look at your DMI, and you can see it's also both below 25. So no trending move going there either. So it's a very, very sideways move. As you can see, I've got 2 lines on the chart. So what we decided to do here is to sell an iron condor spread. So sell the low 20 deltas on the put side. So sell the 36, buy the 34 for protection. Sell the low 20s on the call side. I actually got a little bit higher by the end of the day, but sell the 43, buy the 45. That's what it looks like. And so the break evens there are what you see on the chart. So we have a break even to the upside at the 52-week highs. We have a break even to the downside at the 200-day moving average, as well as a pretty decent volume node there. So as long as we kind of stay in the middle through February expiration, through an earnings announcement coming out, mind you, then we'll be fine. And that earnings announcement, you can see, typically with an earnings announcement where the market's expecting a big move, you'll get $300, $400 of return for about $600-700 of risk when when the market's expecting an outsized move, a bigger than 1 standard deviation move. But that's not the case. We're getting $300-400 for $1,000 of risk. So the market's saying, it does have earnings coming up, but still expect a normal move to come out of it. Here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to others' threads, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment in the video down below on YouTube there. Remember to also like us on Twitter and Facebook as well, and join our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.